Today is our quarterly economic update. And instead of talking at you or talking above you or below you, we want to talk about what we do on a very regular basis right here at CandorPath. So, as Michael is the director of our investments, he directs all of the underlying movement of our investments here at CandorPath. And each and every Monday, we have an investment policy meeting, which is our small committee here gets together and we talk about three different very important pieces about our clients. And the first is, where are we at overall economically? And that's where we're going to start today here just in one moment. After we go over the broad macroeconomic views, we drop down to the CandorPath portfolios, our underlying positions, and how we need to structure things for our CandorPath portfolios. And then last but not least, but most importantly, we talk about our individual clients. And we'll talk about clients for a number of different reasons. One is, what is their current investment positioning? Are there large cash balances? Are there big distributions that might need to come out of the portfolio? And where each client is currently sitting in their overall asset allocation. So we do this each and every Monday. And then once every 90 days, we essentially open up this meeting so that our clients can see what is happening underneath the surface in between our meetings. As I mentioned, we start off always with where we are from an economic standpoint. So that's where we're going to go today. And we've been in a conference the last 2 days. Now, we've been operating CandorPath just like we would be sitting in our office, but we've been at a conference and the entire team has been there. And this conference was really, really great. We saw 4 keynote speakers. We heard from a really well-renowned economist and also a really well-renowned political commentator who, from a bipartisan standpoint, gave us some fantastic pieces of where things are at right now. And maybe that's a really good place for us to start, is first talking about our global economic picture and then talk about what's happening here currently right now in the United States. So without further ado, I want to hand this over to Michael. Michael, where are we at right now from an overall macroeconomic standpoint here? And then I'll follow up with some questions once you go through your presentation.
Absolutely. I'm gonna share my screen over here. So Matt, when I pull it up, make sure, let me know that you can see it so everyone
Sure.
else can as well. But also, I'm going to be monitoring chat while we're talking. So chat should be set up for all of our attendees. If you have any questions, feel free to put them in the chat and myself or Matt will get to them and we'll make sure we answer them along the way. But
And
Matt,
I
can you
see
see
your
it?
presentation. Yep, I see it perfectly. You are good
Awesome.
to go.
Cool. So coming into the end of the third quarter, the markets have continued to go on a phenomenal year. And I'm going to talk a little bit of this chart here in a second, but to sum things up, the S&P 500 is up about 15% for the year through the end of the third quarter. The Nasdaq's up a little more at about 17, pushing 18%. Most notably, and probably the most interesting thing at the moment, international markets. Developed countries are up about 27, 28%, and emerging markets are up 30. And there's some really interesting reasons for that. We can spend some time maybe in Q&A talking about the international developed markets and why they're doing so well. But it's been a positive year despite all of the political upheaval or geopolitics problems that are going on. Markets have somewhat shrugged that off, and not to be outdone, bonds have continue to do well as well. Bonds are posting 6, 7% returns so far through the year. Part of that is interest rates beginning to come lower. We can talk about that, but also the yields that we've been setting up on, those have really begun to tick now, and really begin to get that income coming along. But this chart I show in a lot of our meetings right now because it's centered to what we're doing, and it's centered to our views on the economy and the assessment of portfolios. Because what this chart shows here in gray, which is this squiggly line going up and down, and that's one of my favorite technical terms, squiggly lines, that's the valuation of the market. That's how we value it. We value it and price to earnings. So how much we're willing to pay for a dollar of earnings. Those green dotted lines coming across, those are statistical measures, the middle one being the historic average over the past 30 plus years. And the line above that and below that would be a statistical measure of how far we are away from average. Now, I like bringing this up because where we are today or through last night is this green dot up here in the corner. We're at about 22.8 times forward earnings. A little complicated. Summed up, we're expensive relative to history. We are well outside of the norm. The normal is about 17.1. We're at 22.8. I want to highlight this because we came into the year elevated about 22-ish times. This was the beginning of the year. This was the April pullback that occurred. We did come down in April. If you guys remember, the market pulled back significantly. But since then, markets have rebounded and continued to do well. Now, this is not a call out to say that we're in, that we're going to have a recession tomorrow or that we really need to run for the exits anyways, because I can make the argument why this could make sense. However, I think it's important for all of us to know that we haven't been this historically expensive that often. And realistically, we've got the COVID era coming out of COVID in 21 and late 2020 into 2021, where we had valuations this stretched. And the last time we had valuations this stretched were the late 90s into the turn of the century into the dot-com bubble. So that really sets us up for we got to be careful here. We're priced for perfection, and that's okay if we get perfection.
Michael,
But
I
I
really love
see.
this chart. Yeah, and I
Yeah.
use this in a lot of my meetings. And as complicated as a lot of the charts that we typically show, there's only really two numbers that make up the gray line in this chart. There's only two numbers. It's the price per share of the companies we are investing in and their earnings. And the very simple math behind the scenes here is dividing those two numbers together, right? And coming up
Mhm.
with a ratio of based upon these earnings, how much is a share of the company currently trading for? And the most simplistic way to look at this is when we are above the green dotted line, which is one standard deviation, not to get too technical, we are in a very overvalued situation. And when we are below that, we are undervalued. But more importantly, I think where we use this and apply this to our clients is let's say you got that year-end bonus. Let's say we are currently at the high end of our allocation. This chart is telling us not to move to cash, not to go to bonds, not to change our global mixture, but to slowly start reducing that back down. Because as you've seen, each one of these times we've hit these peaks, there have been the markets look at this as a situation to either collect some profits or to reallocate. And we don't know where tomorrow holds. This chart doesn't show us this. This chart's forward backwards facing. What does it
Mhm.
take for this to come back down into the middle green? It's either prices need to come down or earnings need to go up. It's quite literally that simple. Or and we need to be going sideways. Because I asked Michael this at our last meeting. I said, what does it take for this chart to sort of fix itself? And it's either prices come down, earnings go up, or we trend sideways, which pushes up this average 30-year average to a higher number and makes the peaks seem less like a peak, right? So it's a
Yeah.
complicated chart, but when you boil it down, it's actually quite simplistic.
Yeah. And when we talk about, I think why we want to talk about the portfolios in a little bit about this, but why we're not, I don't want to say overly concerned with this number here, has to do with how the economy is moving. And again, got another complicated chart here, but I really need everyone that's paying attention at home to look at these last two bars over here, because this is 2025 quarterly GDP. Everyone's kind of familiar with in Q1, GDP was actually negative a little bit. It wasn't necessarily negative because there was an issue with the economy, but in quarter one was when we announced the first tariffs in February on Canada and Mexico. And then we began to announce tariffs on the rest of the world that were set to go into place in April, if you remember. So what did companies do? Well, they went out and they imported everything ahead of that tariff deadline. So the math behind this, when you bring things into the company or the country, you're sending money out. So mathematically, that's a drag on the economy. So we see GDP dip here. Move into the second quarter, we imported a lot less. Why? Because we front ran all that. You see that trend reverse it. So we go from a slightly negative quarter to a relatively high second quarter. Interesting thing here to note, the third quarter is trending in a similar direction with a slightly less reliance on net exports there. Why am I bringing this up? We talk about the earnings piece of this. that's a positive sign to show that the earnings are supporting the valuation today. But we need that to continue. So far, it looks like it is. But I think, when we look at this, we want to make sure positive GDP continues to move along so we continue to have strong earnings. And the last thing I want to say about this, because I know we got a lot of things to talk about, why is this valuation important? There's two charts here. They're complicated. I don't want to talk, down to everyone or talk above everyone, but we can talk through it real quick. Over here on the left, this is the forward earnings valuation of the market over those past 30 some years. So every month where the market was valued at is one of these dots over here on the left. And then we said, if you move out 1 year, what was the return that you got at that moment? History suggests there's not a great relationship between 1 year returns and current day valuations. It kind of looks like a shotgun being shot. It's a smattering of things. However, when you switch that over here to the right and say 5 years out, what does that return look like from those valuation points? Suddenly the data becomes a lot more uniform and we can try to put a regression in place. And that gives us an idea of potentially where we could expect returns to be on a 5 year basis, given that valuation. Now, there's a lot of reasons why that might not be the case. But if you notice that red dot right there is our current valuation, the math says we should be relatively trending sideways in the market. Now, there's a whole lot of different things Matt and I and John and I we talk through on how to make these changes to avoid a 0% return and things like that. But when we look at valuations, we take this very seriously, and that's why we sometimes say it's time to ring the cash register. It's like it's time to make those changes in the portfolio and take some money out of equities potentially to protect our gains and use this to help guide us even when it's difficult to sell the equity markets because they still go up.
It really is. And it kind of goes back to one of the core beliefs that we have from an investment standpoint is there's no such thing as set it and forget it. We are firm believers that in order to be able to ride the volatility of the market, you must be able to rebalance the portfolio. And that's not just during the down times, that's during the up times as well. And we're certainly in that peak. And certainly as we get closer and closer to the end of this year, is being able to recognize some of those capital gains. It from a tax standpoint might be slightly painful, but our job here is to make sure that we stay within our portfolio allocation. And this page is a fantastic example of us not making a recommendation to make big moves one way or the other. It's making these small, minute changes to the portfolio to stay balanced. And I think this is a fantastic one. Michael, are we good for some questions now, or do you have another slide to go?
No, I think we're good. Some
Okay.
questions.
All right. First one that I have here is and I think we'd be remiss if we did not discuss this. We are now 7 days into a government shutdown. And the only good news to come out of it so far is that half of the IRS has been furloughed. And so getting a hold of anyone or an audit going on right now. No, I certainly, if a loved one of yours does work for the IRS and they're without a job right now, I don't want to make light of it, but that is probably the only small bit of good news is here. So we're now 7 days into this government shutdown. Michael, how did we get here? Where, in your opinion, do we end up going, and how does this get resolved? And what is the ultimate downflow impact to our clients due to this government shutdown happening right now?
Sure. So let's break this up into a couple pieces. So many companies, JP Morgan, First Trust, Fidelity, a lot of them that we work with have done the research on this, and it's kind of interesting. So historically, before this shutdown, the government had been shut down for a total of 80 days. No recession has ever occurred during a government shutdown. That's not to say one could not happen tomorrow, right? But that's actually never happened. More cheekily stated, we're less likely to have a recession when the government is shut down than when it's open. Very small information set there, but realistically, if you look at the numbers, there are about 700,000 government workers who are considered essential. And I think there's about 600 or so thousand who are considered non-essential. Those essential workers have to go in and work. That is the military, TSA, FAA, the weather service, things like that. Non-essential workers are those that have to stay home, and that's part of the IRS, and it's going to be part of Social Security Administration and things like that. The longer this goes on, the more people we have that are affected without a paycheck. Now, they get their back pay, yes. But the way paychecks work, I think the next government paycheck is supposed to go out somewhere around the 10th to the 15th of October. So no one's missed a paycheck yet. But you have essentially 1.3 million Americans that may not have a paycheck. Is one paycheck a problem? For some people, yes. But for a lot of people, that's not going to change a habit. Two paychecks, is that a problem for consumption? Maybe we begin to have an issue come up down the line. And it might even be more localized in the Virginia, DC, Maryland areas because that's where the federal government's operating out of. Those could be some potential issues. But realistically, 1.3 million workers missing a paycheck out of 160 million people working at the end of the day is not a major economic drag. Unfortunately, we do have a Federal Reserve meeting tomorrow. Not tomorrow, next week. Federal Reserve is not getting statistical data that they need to make decisions. So they're kind of going into this a little cloudy. I would imagine that the Federal Reserve has access to some data. They just don't have the entire picture. So, that's there. But realistically, the longer this goes on, the bigger the issue becomes. But I think for most of us, myself included, but important for all of our clients, would you all want to go to work without getting paid? At some point, a sick day at TSA is going to come in, or the FAA. Does airports get more problematic? I think we spoke to a client this week who called Social Security Administration and waited for 4 hours to get something done because there are staffing shortages. Like those quality of life issues that we have are going to continue, but it's not necessarily that we have a major economic problem that's going to occur because the government is shut down today. Does that kind of make sense?
Yeah, and I'm thinking of a client who's currently listening, and I'm not going to mention any names, who's currently on our call right now. I can see in our participant list, who's waiting for a rather large IRS refund check due to an IRS issue. And I have the probably bad news of saying what we were waiting for is probably not going to come this week because I don't know if anyone is working there right now. But no, I thought that was fantastic. Michael, just last bit on this. So you talked about how this may or may not impact us from an economic standpoint. Why is this actually happening? Why did the government actually shut down right now? And very briefly, what's it going to take for that to be resolved? What fixes the problem that's occurring right now?
Sure. So the government works off of a fiscal year that is October 1st through September 30th. So officially, the government shut down on October 1st this year because it did not pass the proper appropriations budget bill. So the government is only able to spend money the way that Congress tells them to spend money. And it's been, and personally forget even now how long it's been since we actually passed appropriations bills to all the government. We've really been working off of continuing resolutions saying we're going to continue our spending basically the same way it has been for the past several times with minute changes. And that's really the way we've been funding the government for many, many years. And at the end of the day, the issue we have is that we were unable to pass a continuing resolution because that takes a certain amount of votes in both houses of Congress. And as everyone knows, we have a very split and polarized elected leaders at the moment, to put it mildly. But we can't seem to come up with an agreement on how to fund the government. Realistically, I think both parties don't want to be on the hook for this, especially with an election year coming up next year. We will get this government reopened here shortly. It, how long? I don't know. I think we shut the government down for a month during Trump's first term, if I remember. But that's at the end of the day, we haven't given ourselves the ability to spend money at the moment.
And a lot of it is hinged on one major talking point that you may or may not have heard. And it doesn't really impact, no, I'm not going to say that because it's not fair to say, but it impacts Those that impact, it impacts greatly. Let's just leave it there. And that's the Affordable Care Act. For those of you that are on Medicare, this doesn't really impact you in terms of a benefits standpoint. It certainly impacts your wallet and how you pay taxes. And for those of you that are on your company's health plan, doesn't really impact you again, except for your
Mhm.
taxes and how they allocate your tax revenue. But for those that are either self-employed, are pre-retirees, which we work with a lot of clients who are early retirees and needing benefits, health benefits, we are utilizing the Affordable Care Act for that. And the Affordable Care Act subsidies, the credits that help offset the very, very high premiums of that plan are what was not renewed for 2026, at least up to this point. And so it looks like the Democratic side of our elected officials have kind of dug their heels in and said we want a resolution to this before we allow a budget to pass. And the Republicans say, I think an ACA makes sense, but we need to maybe limit who has access to that ACA or make some because it's actually a very expensive program due to the premiums, those premium credits being on the hook of the U.S. taxpayer. So we are very bipartisan in terms of how we have these conversations. Our opinions don't matter. We're certainly looking at the facts. And one side wants to limit spending, and one side wants to continue to have benefits for those, frankly, that do need it, because there's really no
Mhm.
other place to go for health benefits. Okay, let's move on to our next topic here. Our next topic, and you touched on this briefly with your economic overview. Let's talk about tariffs. And I think tariffs are a really, really good one to discuss here today because there's a lot of misnomers about A, what the tariffs are, and B, how they are implemented in our economic system. And I think you even alluded to this, Michael, is that the tariffs were passed some time ago, and we've all, maybe prices of goods and services are continuing to rise. We've not really seen a dramatic increase in goods. And I think the real reason behind that is what you talked about a moment ago, is that once these companies, Target and Walmart and these big companies, realized there was going to be some tariffs on products they purchased, they increased their purchasing and they increased their inventories and have been going off of that larger inventory at their warehouses. As this inventory starts to whittle down and they need to make another repurchase of products that are derived overseas, that's going to be reflected. But more importantly, the Supreme Court is about to decide whether those tariffs were actually legally implemented or not. So let's have a quick conversation regarding the tariffs, because I think they're going to become even more off topic over this last quarter of 2025. Where we stand currently with the tariffs, Michael, what do we think the Supreme Court is going to do? And then how does this ultimately then impact, again, at the end of the day, our clients? Because that's who we care the most about.
Yeah, so I'm glad you're asking about it because I have a couple slides here and I want to share this again. This is actually from our quarterly market update in the second quarter. We had the tariff outcomes listed out before. So this was going back to the beginning of April. Tariffs stay in place, hard to avoid recession. That did not come to fruition because what did we do? Tariffs led to negotiations, the growth scare ends. So, and I have a slide that'll show it here in a second. We said there would essentially be a 30% effective tariff rate, and that has come down to less than 20. It's in the mid-teens right now. But we essentially put tariffs, but not in the way that they initially were put in place. Congress has not stepped in on the tariffs, but where we at right now is that there are different states and organizations suing the presidency and the Supreme Court over his authority to put these in place. Now, what that actually comes out to be is up for debate when the Supreme Court begins to hear these arguments. I believe in November they begin. But what it seems to be is that the Supreme Court likely leans towards this being illegal or not. He doesn't have the power to do it in this way by a tight majority somewhere. But the issue here is twofold. One, we've through the end of August got almost $150 billion worth of tariff revenue. Through the end of September, that number is probably going to get closer to 200 billion, but because the government shut down, we don't have that number yet. We're likely to have collected more than $200 billion in tariffs before this is resolved. That's going to be very difficult to pay back. when you're already running a deficit. And it's actually interesting, the legal arguments on tariff. There was congressional action post Great Depression era, which deferred a lot of authority on tariffs from Congress to the president at that time. Now, the way that those have been in place and on different regulations, this is what's going to be kind of the interesting legal precedent, is that the way the president put the tariffs in place today may not have been the actual appropriate way of doing it based on the powers that he has. And it's likely that we think the Supreme Court may come out and say the tariffs as they were put in place were not done so correctly, but we do think he has the power to do this in another manner. So we may give him a window of opportunity to put them in place in a different manner. And if he's able to do it in that time period, we won't have to pay the money back. Now, if you're following that at home like myself, seems like that's somewhat convoluted, and it's likely that this answer is convoluted and it's technical in aspect. It, the Supreme Court's not going to want to say you got to pay back hundreds of billion dollars in tariffs. It's likely that the president does have the power to put a lot of these tariffs in place because if you actually read what he's doing in a lot of these countries, he does probably have the power to do it. Brazil's kind of the funny outlier that specifically seems to be a lot more political than it does any sort of geopolitical reasons. We can get into that separately, but I do think likely we see these tariffs remain in place in some manner, albeit probably not the way they are today. Does that make sense,
Great. And
Matt?
that's a great summary. Yeah, it does. And again, a lot of this is up to court interpretation, and we're going up based upon, almost 100 years ago of the last time these powers were used in this way. And it's going to be interesting to see that. But I do agree with you that there will probably be in one hand saying you can't do this, but if you switch this, then you can do this, and things continue on as is. And I can't see a scenario where we're writing checks back to some of these countries. And I think where this ultimately goes is, again, the impact to this is an increase in overall prices, an increase in overall goods and services. And we're hoping is the Fed is sort of offsetting that with our decrease in interest rates to sort of maybe absorb some of that might be coming down the pike. So we'll see where we go there. Last bit I want to talk about, and we're trying to stay topical with this, and I'm not trying to get too much in the weeds, but I've answered more than the dozen questions recently regarding our federal deficit, which again, this tariff is hopefully helping to offset some of this, but we are talking about 37 trillion, and that's with the T. And you could pay me, I guess, $1,000. Let's just use that number. I could not tell you I could not monetize to you what 37 trillion is. But I always do this in my meetings. And if I'm meeting with you regularly, we do have this conversation. Is I remove all those zeros, and I say, okay, I make $50,000 a year, and I'm spending $80,000 a year, and I have approximately a $30,000 a year that I don't have, but I'm spending it. I'm putting it on credit cards, or i.e. in this situation, the US Treasury. We have a huge federal deficit. This tariff is hopefully slowly starting to, future will reduce that. We still have a spending problem. And specifically within that comment, the spending is really our entitlement programs, which are the most expensive. Now, as I look again through our half a dozen attendees here, that there are a lot that are currently on Social Security right now. And they say, Matt, if they take that away, we're going to have a really big problem. And I don't think that that's going to happen, by the way. But I certainly think that as we get closer to really a main date of 2032 or 2034, depending on which numbers we're looking at, there's a change that needs to take place with Social Security simply due to the fact that our deficit is so shockingly high right now. Michael, let's talk about Social Security. Let's talk about our deficit. And what are some things that we are going to see down the road that we want to prepare our clients for? And this not just impacts our retirees, this impacts those that are pre-retirees, maybe 5 years away from Social Security. It also impacts those like ourselves who are accumulators, still paying into our system. 15% of our paychecks, half by our company and half by ourselves, are going to fund Social Security. Will we receive that money back at some point down the road as accumulators? So using the lens of our federal deficit, Michael, Let's answer some of these questions right now regarding Social Security.
Sure. So, as you pointed out, we don't take in enough to cover our spending. And that really comes out into a couple different ways. If we look over here, what our spending is, it's a little bit over $7 trillion, $70,000, however we want to break it down. Defense is 860 billion. Medicaid, Medicare, Social Security are all in here. There's some other non-defense discretionary and other mandatory spending. The real problem we've had in the past 2 to 3 years is this net interest has gone from relatively little with low interest rates over the past 15 to 20 years to almost $1 trillion annually right now with higher interest rates. So when we hear about, first of all, the president coming out and demanding interest rates be lower, keep in mind, in his mind, this is an artificial expense that we shouldn't really be paying because we control the interest. That's why we want it to get it lower. One of the reason. When we actually look over here at the deficit, this chart follows the annual deficit up and down. It might be hard for everyone to see at the moment, but the gray is the deficit or surplus, but mainly deficit spending, and the blue is that added net interest expense on. So in the next 10 to 8 to 10 years, that net interest expense gets really expensive and makes up more than half of the deficit. That's one reason why we really need to get our hand around the debt from a fiscal deficit perspective, because it's beginning to cost us more. Having $37 trillion in debt, relatively speaking, isn't necessarily a problem because we just pay the interest. We're not retiring it. But when your interest bill gets more and more expensive, that becomes a problem. And you brought up a huge issue that we're going to have in 2032 to 2034 is that Social Security, in theory, goes bankrupt. And that's kind of a misnomer, and it's spread around, unfortunately, because that's not really what happens. Social Security at the moment is this entitlement program where you pay in a certain amount, and when you retire, there's a formula that tells you how much you get out every month. The problem at that time period in 2032, 2034 is that the revenue that the asset of Social Security itself and the new dollars going in does not offset the expenses going out. So the revenue does not match the expenses. At that point, somewhere in 2032 to 2034, there's an automatic 20% reduction in benefits across the board. And that's simply put to keep the asset there and not allow it to be drawn down over time. What does that mean for all of us? One, the outcome that a 20% cut is probably unfathomable for most Americans. Most Americans use Social Security as their retirement plan, right, wrong, or indifferent, and they're not going to be able to stomach a 20% decrease in benefits. Number one. What does that mean? Well, we're going to have a congressional election in 2028 with a presidency that is probably going to have to deal with this in their time frame. Maybe that's before the midterms in 2030. Maybe that's afterwards. What does that probably mean? Probably means several things. One, you have to look at the spend side. So as Matt pointed out, as an entitlement and non-discretionary spending, Social Security has benefits it has to pay. But right now, that ranges from you being able to take it at age 62 all the way to age 70, with full retirement age being somewhere after 67, depending on how old you are. It's likely that we could see something like full retirement age going to 68 and early retirement moving to 63. That's one possibility to help fund this because not one fix is going to magically fix this situation. It's also likely that you see the Social Security tax being uncapped on those that are working. So, Matt, you brought up accumulators. If you're a high wage earner after 175-ish thousand, somewhere around there this year, you stop paying into Social Security. You still pay into Medicare, but you stop paying into Social Security. We may see that cap removed. And the downside to that is really to make that make sense. we're going to remove that cap or you're going to cap your benefits. Meaning, at the moment, if you pay in highly above that rate, you stop paying in because there's no benefit to you in the future. Realistically, we're probably going to have to look at wage earners and say we're going to limit your benefit moving out, but we're still going to ask you to pay in for everyone else. And it's likely we could see some sort of means testing in the future on Social Security, though that's a little bit more controversial, but there's going to have to be some adjustments everywhere, whether it's the formula to come to benefits, the amount of money that goes in, or how the money's coming out. All those are going to be tweaked. If we do it correctly, no one's really going to feel the entire brunt of that change. However, there are going to be losers in this situation at the sacrifice of making the most people win. Hopefully,
Yeah,
we can do that in the least painful way.
2034 or 2032, I've been in this industry. I started in 2002, 23 years ago. I always knew we were kind of like working towards this impending, and there's always been the conversation about how Social Security is eventually at some point, and like all of a sudden now we're like 7 to 8 years away. Like it becomes much more real. And it's an understanding that I think you kind of summed it up very well. Everyone's going to have to chip in to fix this problem. Those accumulators, more of your income will probably be allocated towards making those Social Security, that FICA tax, which we all pay. Those on benefits now, maybe you're not receiving those generous cost of living adjustments, which I say generous as an accumulator, but as you living off of a fixed income and the price of goods and services are rising around you, you feel those pinches probably more than the accumulators do in some situations. And last but not least is the change in taxation overall about how Social Security is taxed, or if there's a mean test to that. So we are going to stay on top. It's going to be very fascinating to watch, and ultimately, it's up to us as we build our retirement plans for our clients is to make sure we are factoring in some of these changes that may or may not occur, more than likely will, and making sure that we guys set you up for success. So with that said, that concludes the economic portion of what our typical Mondays look like. We're now going to briefly dive into two additional portions. The first is to talk about our Candor Path portfolios. And then last but not least is we're going to talk about what we discuss on Mondays regarding our individual clients and things you need to be looking out for between now and the end of this year. Again, using that same theme of talking about our accumulators, our pre-retirees, and our retirees. So Michael, our Candor Path portfolios right now, again, we're not going to talk about security selection. That's more for a one-on-one meeting. But I think we need to spend some time talking about our allocations. And when I talk about our allocations, as Michael's going to kind of dive into briefly here, is that when I say that we are in a 70% equity and 30% fixed income portfolio, what does that mean? And where are most of our portfolios at? And what are some of the corrective actions we need to take place here over this last quarter of the year?
Yep. So when we think about our portfolios, first of all, everyone's portfolio is different. I have to talk about this in broad terms and be a little compliance proved here. But when we talk about someone's portfolio, generally speaking, for a lot of our clients, it is a division between stocks and bonds. So if someone says, hey, I have a 60-40 or I have a 70-30, generally speaking, they're talking about having their equity allocation at around 70% and their bonds around 30%. Now, within those two buckets, we then break that out into a couple different areas. So on the equity side, we have our US bonds, our US equities, and our international equities. Within those international or those US equities, we break that out into active growth or quality or dividend growers or just an index. And we assign weights to those and we move the portfolio around. In bonds, it's the same way. We have core bonds, some very conservative bonds. Then we have some that are a little bit more higher yield or riskier bonds. When we put all of that together, that's your portfolio. And what we want is for that portfolio to work together in a way to give a good return or a sustainable return, whatever the correct terms is. But we don't want any certain area of the portfolio to really dominate or hinge your success on, but we want it in its entirety to build up for you. But at certain times, something's gonna work and something's not gonna work. We've talked about this in years past, where the market may be down, but our value-oriented pieces are down a lot less. They're being more stable. Or the market may be roaring and the growth is roaring even more, but our value is staying back. And there's a evening out that we try to achieve with the portfolio. But I want to go back here real quick because I think it's important to take a look at when we make these changes to the portfolio, we look at valuations as one of the main driving decisions. And just if someone's a 70/30 and we see valuations get up here, it may be counterintuitive, but just because you're 70/30 doesn't mean you suddenly need to be 30% in stocks and 70% in bonds, and we're going to go sell everything to move it. That's not really the case because what we want to do is we want to go in, we want to trim certain things because your total market index valuation may be 22.8, but your small caps might be 15. We don't want to sell the small caps the same way we're selling the large caps. So we want to trim that position and bring it back. So your 70/30s, you might have noticed back in June, we made a trim on our equities and our 70/30s became 67/33. And then as the market continued to go up, because it did from June, we're looking at potentially doing that again in our IRAs, maybe even some non-qualified accounts, maybe into 2026 for tax purposes, but begin to continue trimming things along the way to make sure that one, we're ringing the cash register when there's gains. I don't know if anyone ever goes to the casino, but you never go broke when you leave ahead or when you do things like that. So we want to make sure that when the market is going up, we are trimming along the way. But we also know any given year, there's also pullbacks, right? And that we've talked about this before. Over the past 45 years, 34 of them were positive. That's a 75+% rate of positive returns. However, almost every year there are drops. Actually, the average drop over the past 45 years was over 14% any given year. This year we're up 14, but we saw a 19% drawdown. Again, that was that April low. One, we want to make sure the portfolio is built so that all of our clients can stomach this drop because it's going to happen. Generally, it happens every year. Occasionally, there's a -3, there's a -6 every now and then, but every year there's generally a large drop. So we want to be able to stomach that. But again, when we're up very high, we want to trim those equities and have the ammunition to buy them when they're cheaper. And
Yeah.
that's what we're trying to get. When people say buy low, sell high, it doesn't mean getting rid of all your equities at the top. It means when we're near tops, trim. When we're at the bottom, go buy. It's behavioral focus.
I love this chart, and I think it just, again, points more to the fact of we are not trying to get in and out of the market. We're not trying to have a specific security selection. We have a very targeted allocation. We are going to make small rebalancing along the way to capitalize both during the good times and during the bad times, and that hopefully smooths out the ride for the long term. So fantastic chart. I think you really kind of hit the point home. So again, for our Canter Path portfolios, just to summarize, again, if we are over that allocation, we're going to be trimming that back here this quarter because the evidence tells us to do so. And so slowly trimming back for those that have these large year-end bonuses. All right, we're going to maybe not put that into the equity markets. We're going to maybe put that a little bit on the side just to see where things go from here and continue to just slowly proceed with our allocation plan. Fantastic. Okay, with our final 15 minutes here, I want to spend 5 minutes each on our three different categories of clients and give some very directive information about those three. So let's first start with our accumulators. And again, our accumulators are those, it's very simply, those are currently working right now. You're more than 5 years or so from retirement and all the way up to our second and third generation of clients who are maybe just entering the working years or entering their peak earning years, somewhere in that 40 to 60 range. So what should, over this last quarter of the year, some of the focuses be for those clients? Mike, I'll let you start off first, and then we can bounce back and forth.
Sure. So I think for me, the number one thing I think of for accumulators every year, especially those in prime working years, have we funded to the max our retirement vehicles that way we can? Our 401ks Are they already max funded or are we on track to max fund if we can, right? Or have we done our IRAs? If we had planned savings, did we save in our non-qualified buckets correctly? Just want to make sure that we've got that done. And then the second piece of that, do we have a tax plan, right? Do we know if we're going to owe money come April? Do we have things set aside already? Have we just gone to the tax doctor for our annual checkup and make sure everything's good? I think
I can
those are the
tell you that
things.
most clients did because the amount of tax pro formas that were done by the team here this year was, I think, on record the most. But what I love about that, I think it's a great point, Michael, is that those tax checkups are what we're trying to avoid a surprise come next April, which is as bad as some of those checkups have been with, hey, you got a little bit of high blood pressure and cholesterol, we got to reduce that back, i.e., you didn't withhold enough or you made more money than we anticipated, is giving us plenty of time to make that corrective action between now and April when that amount is due. So I think those are two amazing points for our accumulators. Again, just to summarize, is as open enrollment comes in for your benefits is checking to make sure, hey, did I hit my maximum savings goals for my retirement accounts? Did I fund that health savings account? All of those benefits you have available to you. Remember, they start over for the most part on December 31st into January 1. So we have the next 90 or so days here to make sure everything is funded correctly, that we hit the numbers we're trying to hit here for 2025. Okay. Moving on, our next group of clients is our pre-retirees. And again, our pre-retirees are those that either are less than 5 years from retirement or have retired early. They retired in their early 60s, late 50s. And we have a number of
Mhm.
clients that worked their butts off during their careers, and their goal was to retire well before the traditional retirement age of mid to late 60s. So for our early retirees, I think I have two things to hit on because those are the ones that I'm dealing with a lot here within the firm. Is the first is for those pre-retirees is making sure that we are keeping an eye on our modified adjusted gross income. Kind of goes back to that tax conversation for our accumulators, is that if you're a pre-retiree, taxes right now are arguably a really large bill that could sneak up on us. And if you're a pre-retiree, we have a very tight income plan. So we want to make sure that there's no surprises for our modified adjusted gross income. And why is the modified adjusted gross income so important? Is because those pre-retirees, as we talked about as the early part of our conversation today, a lot of them are using the Affordable Care Act to bridge them from their current health benefits over into Medicare. So they're in this window, this no man's land of not having benefits that are traditional that we see in our W-2 employees, and they're too young to get on that. Now, where I think you should be watching right now, and you're going to know that we're going to stay on top of this, is watching what legislative changes come from the change to the Affordable Care Act. Again, it's going to be really tight in line with how the government shut down, how long that lasts for. This is what they're fighting over. They're fighting over
Mhm.
Affordable Care Act. So again, for our pre-retirees, modified adjusted gross income, which we hit on just about every one of our meetings. And then, like I said, watching legislatively what occurs. This is all out of our hands. So we're watching our elected officials battle on behalf of ourselves. Again, there is a downside to the plan, which is the overall cost and the expenditure to the American public. But then there's the other side to it of a much needed benefit that truly doesn't exist anywhere. Before the Affordable Care Act, right, wrong, or indifferent, there was no option except for going in for private health insurance to gain coverage. And this is not just for the early retiree who's wealthy. This is also for those that are self-employed, and also for those that are underemployed or whose or company does not provide benefits, or maybe they're a subcontractor and do not receive some of the traditional benefits that employees receive. So there's a lot at stake here, again, especially for our pre-retirees. All right. Last bit here is for our actual retirees. You are in retirement. All of these conversations about where the market's going and where Social Security is going, it's in the back of your mind, but I'm hoping right now you are either on your way to a fantastic trip, or you're out gardening, or you're volunteering your time or doing something amazing and not watching the ticker screen roll across all day long. But let's talk about, again, with our last few minutes here, Michael, our retirees. What are some of the things that they need to be thinking about here over this last quarter of 2025?
I think number one thing that comes to mind for retirees is cash flow management, right? You've left the workforce. We're living off of Social Security, our assets. One, we got to make sure that that cash flow stream is continuing on correctly. Are there any issues, hiccups, things that need to be looked at to make sure that one, money's still coming in the door, but two, I almost don't want to use the I word because we haven't used it that much during this call, but are there going to be any inflationary effects that are going to change needs? So take a review of that, seeing if we're feeling any pinches along the way. But one of the things that feeds into that for a lot of retirees is the RMD. Have we completed it for 2025? We have a process for all of our clients where we look at them, we know what they are, we have them calculated if needed, and we get them out. Part of that can be systematic to your bank account. Part of that may go to your non-qualified account if you don't need it. And sometimes that's a great way to pay our taxes. We withhold a lot of that and send it directly to the IRS. But make sure we get that plan in place to satisfy that. Because if we don't, that's a nasty penalty come next year. And that's something that we try and make sure that we at least have a plan for all of our clients. But let's make sure that we get those RMDs taken care of. And then if we haven't taken care of the RMD or we're just really charitably inclined, there is this nice piece in the tax code once you attain 70 and a half to do a QCD or a qualified charitable distribution, in which case we send money directly from your retirement plan to a charity and we're able to keep that from showing up as income on our taxes. And Matt, I know you know that area extremely well, so correct me if I'm wrong on all of that, but we want to make sure we get those done because those have to be done within the calendar year. They can't go back like a IRA can. Is that right?
Yeah, correct. So again, all of this just goes back to planning. As Michael mentioned a moment ago, cash flow, making sure we have enough cash on hand to make out those systematic distributions so you have money to live off of. Making sure we don't miss the very important required minimum distribution window, whether it's your first year taking an RMD and you're unsure of how it actually works, or you've been doing this year over year. Remember, this number is calculated differently each and every year. Your account value is one component of it. The second component
Mhm.
of it is your age. So this number changes. We don't know what your next year's RMD is going to be until we hit December 31st. So for us, planning is absolutely critical. And then, like Michael said, for those that are wanting to give to their favorite 501c3 charities, and we have the conversation, the recommendation that there's a great opportunity to, instead of funding that out of your cash flow, as for those that are over the age of 70 and a half, is actually fund it from an IRA distribution. There's a tremendous amount of tax benefits that have that implication to it. So we are now here with 4 minutes early for our webinar here. Let me just end this by saying this is not the only webinar we do. In fact, I think, and Raina will correct me if I'm wrong, this might be the 12th one we've done this year. The next upcoming one, I believe, is going to be on Medicare with John Kennedy. He times out with open enrollment for Medicare. If you are approaching Medicare, if you're on Medicare, if you have questions about Medicare, that next webinar, keep an eye out, is going to be a phenomenal one to be on. He's going to go through the ABCs of Medicare. The guy can do that presentation in his sleep, although he is going to be on point for it. And it's a really, really good one. What we love about it is, again, for those that have just so many questions and are coming up to either age 62 or age 65, or really it's more for 65. Those that are early kind of want to know what's going on with Medicare. But for those that are approaching 65 and just need to know the ABCs of it, you're going to get really objective, really, really great information about Medicare itself. So with that, any last thoughts here, Michael, before we turn everyone loose?
No, I think for me, the number one thing takeaway, I know I spent a lot of time talking about valuation. It's not something to be scared of. I don't think either one of us is saying there's a recession around the corner or dare I use the B word bubble. It's just something to be aware of and something that we focus on a lot right now when we do our rebalancing. It's always good to trim things and get them back in the way we want them to. Inevitably, the market will pull back. It always does every year. We just want to be prepared for that and make sure along the way we've done everything we can.
Awesome. Well stated. On behalf of myself, Mr. Michael Scott, the rest of the Candor Path team, we thank you guys so much for being a part of our quarterly economic update. Remember, this economic update, if you're not watching it here live, is available on YouTube. Send it out to a family, a friend, a loved one, someone who is really confused about what's going on and maybe have some questions that we would love to be able to answer. So again, on behalf of myself, Michael, the rest of the Candor Path team, thank you guys so much for being a part of our Candor Path family. We love you guys. and we will see you on our next webinar.